Hey traders, going into the week of 8th of February, 2026. Last week, the VIX moved from 19.95 to 17.77, signaling easing volatility and a calmer short-term market environment. The U.S. 10-year yield sits at 4.208% versus 4.239% last week, pointing to slightly easing rate pressure and a modest pullback in bond yields, which can provide short-term relief for equities without signaling a clear shift in the broader rate trend. TLT is trading above the 30-week SMA, signaling a stage 1 or 2 environment and indicating that the intermediate-term trend in bonds remains constructive. Option sentiment data shows a total put-to-call ratio close at 0.86 versus 0.73 last week, while the equity put-to-call ratio closed at 0.58 from 0.6 the previous week. This suggests rising demand for downside hedging at the broader options level, while equity-specific sentiment remains relatively constructive and not overly defensive, pointing to caution without outright fear in market. The percentage of stocks in the S&P 500 above their 50-day moving average stands at 68% versus 66% at the end of last week, signaling improving short-term market breadth. At the same time, the percentage of stocks in the S&P 500 above their 200-day moving average is 67% versus 64%, implying that medium-term market breadth is strengthening and the broader uptrend remains intact. Additionally, 66% of the index constituents are in stage 2 advancing phases, reinforcing the view that the market's intermediate-term trend remains constructive despite short-term breadth fluctuations. Key takeaway: focus on buying strong stocks in strong sectors, i.e. energy, industrials, and consumer staples, while being selective on shorting. The market is constructive overall, with improving breadth and easing volatility. This is data vesting, trading with science, not emotions.